By the end of this video, you'll know exactly how to calculate cash on cash return and why it's the metric that separates smart investors from everyone else. And here's the thing. Most people never learn this formula in finance class. It's learned in the field. So sit back, grab a cup of water, and let's get into it. Here's how cash on cash return works. You take your annual pre-tax cash flow. You divide it by the total cash you actually invested. That gives you a percentage. That percentage is your cash on cash return. Let me make this concrete. Say you buy a rental property for $200,000. You put down $40,000. Closing costs add another $3,000. Renovation gets you another $7,000. Your total out-of-pocket cash is $50,000. Now, that property nets you $400 per month in cash flow after all expenses. 400 times 12 months. That's $4,800 per year. Divide $4,800 by your $50,000 investment. You get 9.6%. That's your cash on cash return. This is the metric every rental investor should calculate before signing anything. It tells you exactly how hard your money is working. But here's what most people get wrong. They stop here. They see the 9.6% and they think they understand their investment. They don't. Point two is where things get interesting. Cash on cash return becomes powerful when you use it to compare properties across different price points and financing scenarios. Consider two properties in the same neighborhood. Property A costs $300,000. Property B costs $180,000. Same rent, same expenses, same neighborhood. Property A needs $50,000 down. Property B needs $30,000 down. Same bank, same interest rate, same loan term. Which one is the better investment? Property B, every time. The cash on cash return on property B will be significantly higher because you're deploying less capital for the same income. This is the insight most first-time investors miss. They're so focused on the purchase price that they forget to ask the real question. The question is not how much does the property cost? The question is how much of my money does this deal require? And what does that money earn me back each year? I worked with a woman named Diane about 3 years ago. She had $250,000 to invest. She was dead set on a high-end condo in Austin. Beautiful finishes, great location. $450,000 with 20% down, $90,000 out of pocket. She found it a rental that covered the mortgage, but barely anything left over. Cash flow of around $220 per month. Her cash on cash return came out to less than 3%. I asked her to look at a duplex 30 minutes away, $160,000 per unit, $32,000 down per side, $64,000 total. Each side rented for 80% of the Austin condo. Combined cash flow of $1,100 per month. Her cash on cash return was over 20%. Diane bought the duplex. Her equity buildup is accelerating. Her cash flow covers the mortgages and then some. She's refinancing the appreciation out now. She's building wealth at a rate the condo never could have matched. Same money, completely different outcome. All because she understood what cash on cash return was actually measuring. If this is clicking for you, hit subscribe. I drop videos like this every week, and the best one is coming up next. All right, now, this is the one I saved. Point three. Here's what separates amateur investors from professionals. Cash on cash return tells you about cash flow. It does not tell you about appreciation. It does not tell you about equity buildup. It does not tell you about tax benefits. And it absolutely does not tell you about the leverage advantage. Let me explain the leverage advantage, because this is the concept that changed my entire investing philosophy. You buy a $50,000 property with $50,000 cash, no mortgage. You get $5,000 per year in cash flow. 10% cash on cash return. That's solid. Now, you buy the same $50,000 property with $10,000 down and a $40,000 mortgage. Your annual cash flow is now $3,000 after the mortgage payment. 3,000 divided by 10,000. That's 30% cash on cash return. Same property, same total investment. Vastly different cash on cash return. You're using other people's money to amplify your returns. That's leverage. And cash on cash return captures this effect better than any other metric because it measures return on the cash you actually put in, not the total property value. This is why investors who understand cash on cash return often prefer financing with higher interest rates on investment properties. They don't care about the interest rate. They care about how hard their cash is working. A 6% loan on an 18% cash on cash return deal is a great deal. A 4% loan on a 3% cash on cash return deal is a terrible deal. Think about that. The National Association of Realtors tracks investor purchasing patterns every year. Their data consistently shows that investors who analyze deals using cash on cash return as a primary screening metric hold properties longer, refinance more frequently, and build equity faster than investors who focus solely on purchase price or cap rate. Cap rate measures yield on the total property value. Cash on cash measures yield on your actual cash in the deal. For most individual investors using financing, cash on cash is the more relevant number. Here's the professional move. Screen deals using cash on cash return. Set a minimum threshold based on your market. 8%, 10%, whatever makes sense for your goals. Then, once a deal clears that screen, layer in your other analysis: appreciation potential, repair costs, tenant demand, exit strategy. Cash on cash return is the filter, not the entire answer. So there you go. 3 things you can do starting today. Calculate the cash on cash return on any rental property before you buy it. Compare properties based on the return on your actual cash invested, not the purchase price. And use cash on cash return as your first level filter when screening deals. The duplex Diane bought. That property is now worth 40% more than she paid. Her cash flow has increased. Her equity is growing. And she started with the same $250,000 she almost put into a condo that would have returned less than 3% annually. If you got value from this, share it with someone who's looking at rental properties. And subscribe. I've got something even better coming next week.